Thank you for tuning into the webinar today on impact of VAT on advance payments received from customers in the UAE. I'm Rajeshri from the Zoho Books team. Most of you here will be knowing Zoho Books, but for the benefit of those who are new and trial users, Zoho Books is our VAT compliant accounting software which helps businesses manage their finances. We have with us Mayank Soni, who is the presenter for today. We have him with us for the third time now. And for those of you who are not familiar, he is the Managing Director of Max Growth Limited and Max Growth Consulting. He is also a corporate finance and consulting professional with over 19 years of expertise on VAT advisory, international taxation advisory, and private equity. He has worked with large MNCs and government organizations such as the Office of His Highness the Crown Prince of Dubai, and you can find his articles and columns on VAT in Khalij Times and Gulf News. He is a well-recognized VAT expert and a member of the Indirect Tax Committee of ICAI in the UAE, which is responsible for evaluation and training for ICAI's certification courses on GCC and UAE VAT. Today we have him with us sharing his insights on the various aspects of VAT and its impact on businesses handling advance payments. On behalf of all of you, I welcome you, Mayank. So, a quick heads up of the session today. We will be having a presentation followed by a question and answer session. All you have to do is post your questions in the question box located in the control panel, and rest assured your questions will be answered. And without further delay, let's get started.
Thanks for a wonderful introduction, Rajshri. And good afternoon, everyone. This is Mayank Sahani from Max Growth Consulting, your host for this webinar. And I'm here with you to resolve any doubts, any queries you have on VAT. This is our initiative together with Zoho team to help the small and medium scale enterprises in UAE to apply the provisions of VAT law correctly in their businesses. And we are running a series of webinars over past few months, and we will continue doing that, where each area where we see mistakes happening or doubts arising amongst businesses, we will pick up that topic and we will be there to help you in applying the provisions correctly. So today's topic is one of the most common areas where we are seeing where most of the SMEs have actually gone wrong in applying the provisions of VAT law in UAE. That is, the advance payments collected from customers. It is a common misunderstanding between a lot of small and medium enterprises in UAE that the VAT is only applicable upon actual supply of goods or services. This understanding is not at all correct, because the concept of time of supply provided in the VAT decree law of UAE and the executive regulations governing it is what determines when the VAT becomes applicable on any given transaction. Therefore, it is important for all businesses in UAE to understand the concept of time of supply as provided under the VAT decree law of UAE and the executive regulations governing it, rather than applying the meaning of time of supply as understood by a common man in the common parlance. Therefore, in order to understand the treatment of VAT on advance payments received, which is the topic which we are going to focus on today, it is first important to understand in detail the concept of time of supply provided under the VAT decree law of UAE and the executive regulations governing it. As regards the concept of time of supply under the VAT law, that is, when are you required to charge and account for VAT as the supplier of goods or services in your books of accounts and account for in your VAT return as well. The purpose of this topic is we understand correctly when the liability arises to account for output VAT. This is to ensure that the VAT is declared by you in the correct tax period. As per the VAT decree law, the time of supply is considered as the earlier of following three events, which means whichever of these three things which I'm going to describe now happens earliest in the chain of events on any given transaction, your liability to account for, charge, and report the VAT in your VAT return becomes due upon happening of that event. The first event is receipt of payment, whether in part or in full. So, which means if you have received advance from your customer as a first thing in a transaction, whether it is a part advance, for example, 10% of the contract value, or it is a full advance payment, or it is 50% advance, whatever the case is, the moment you receive any sort of money from your customer, and that is the first thing which has happened in your course of your transaction with the customer, then your liability or responsibility to account for VAT accrues on the date you have received such payment. The second event which you have to consider is the date of issuing a tax invoice. In case the first thing you do in your dealing with the customer is to send them a tax invoice, then the customer either makes you a payment or you supply them goods or services. Then if the first event in a chain of transaction with the customer is issuance of a tax invoice from your side, then your liability to account for VAT accrues on the date you issue the tax invoice, irrespective of the fact that you have received the payment from the customer or not, and irrespective of the fact that whether you have supplied the goods or services to the customer. The third and the last event which you have to consider is whether the actual supply of goods or services happens as the first event in the chain of transactions with the customer. So there would be a lot of cases where you supply goods on a delivery note, or you provide services but you take some time to raise a tax invoice on the customer, or the customer takes a further time to make a payment to you. So irrespective of the fact that you have not raised a tax invoice or you have not received the payment from the customer, if you have actually supplied goods or services on a certain date, you are required to account for VAT on the supply of goods or services, account for that in your VAT return, and pay the VAT due on that supply to the Federal Tax Authority. So the law has been drafted in a way that the collection of tax revenue to the government or to the Federal Tax Authority happens earliest. That's the reason they have drafted these provisions, that whatsoever happens earliest between any of these three events in a transaction, you are required to account for VAT on that transaction as a supplier and pay that VAT to the government and the Federal Tax Authority. So I hope that clarifies the situation. We will drill down more in detail in the future slides on this particular concept. The next slide, which you can see on your screens, is basically a further elaboration or a more pictorial elaboration of what we discussed just now, that as per the VAT decree law of UAE and the executive regulations governing it, the liability for VAT arises at the earlier of 1. When goods are removed or made available or services are performed by the supplier. 2nd, when the tax invoice is issued by the supplier. And 3rd, when the payment is received in part or full by the supplier. So whatsoever is happening the earliest amongst these three events, you account for VAT in your books of accounts as well as your VAT returns for that period, and you pay your VAT liability to the Federal Tax Authority at that point of time. So it creates a bit of practical issues on how you're going to account for, and there will be reconciliations happening between the two periods. For example, if you are accounting for VAT upon receipt of advance, an actual supply happens in a subsequent period, then how do you report your revenue? Is there an overlap in reporting of revenue? We will discuss and resolve all those issues in this webinar for you and tell you how do you do your accounting entries in this case in the correct way, which allows proper accounting treatment, and at the same point of time it allows you to comply with the provisions of the VAT law. So you have to make sure that you still account for as per the accounting standards, and you still pay your VAT liability as per the VAT law of UAE, because these are two different things. The accounting standards, the IFRS and other accounting standards which you may use in your business, they are still going to continue on their own basis, and the VAT law has to be applied in essence on what the law provides for. So you need to do your accounting entries in the right way so your accounting standards are not violated, neither is the VAT law violated. Elaborating further on the topic and dividing it into two categories, that is to distinguish between the supply of goods and the supply of services. As you can see on your slides which are coming now, that in case of supply of goods, the transfer of goods under the supplier's supervision or possession of goods by a recipient or the date of completion of assembly or installation. This is a case when you are supplying the goods locally to a customer within UAE. What will be considered as the date of supply if that is happening? So these are the three things you might look into. That if there's a transfer of goods under supplier supervision, which is you are responsible for transporting the goods to customer's location. So in that case, the date on which you are supplying those goods becomes the date of supply, or the date on which, if the contract says only when the date on which the customer receives the goods, that will be considered as date of supply, then the date of receipt of goods is considered date of supply effectively. Or if a goods involves supply of goods and it has to be assembled or installed at the customer sites, then the date when you complete that assembly or installation, that becomes the date of supply. In case of import of goods, the date on which the import declaration is filed with the customs authorities in UAE, that becomes the date of supply. In certain cases, you will have contracts with your customers where the supply is not considered as completed till the time the customer has inspected the goods and has formally accepted them after inspection. In those cases, the date of supply will be considered as date of acceptance by the customer. And then we come down to the other conditions, which are the receipt of payment, which is the advance payment received in full or part, and the issuance of tax invoice. So this is just an elaboration of what we discussed, and it just further elaborates the concept of when the actual supply of goods gets completed. On a similar basis, if we move to the right hand side of our slide, it covers the date of supply of services, and the VAT liability on services is accruing on the earliest of completion of service, receipt of payment, or issuance of a tax invoice. What is important to understand over here is when we talk about the completion of service, it is not only the completion of full service, because if the contract provides certain milestones within a full service contract, then each completion of milestone is considered as a completion of a part service, and on the portion of the contract value which accrues upon the completion of that particular milestone, the VAT liability becomes due at that point of time. For example, if you have a contract for 1 year which has 4 different milestones, which on an average happen every quarter, then whatsoever portion of the milestone is completed in say quarter 1, On that milestone, the VAT becomes applicable in quarter one itself. Similarly, whatsoever milestone is completed in quarter two, on that milestone, the VAT becomes applicable in quarter two, and so forth and so forth. Important thing to understand is the date of supply of the event is determined by the earliest of these three things, but the law provides you a 14 days grace period to issue a tax invoice. So there is a leeway or a relief which is given to you in the law that for any reason, if you are not able to issue the tax invoice to your customer upon the date of receipt of advance payment to them or on the date of supply of goods or services to them for any reason, you can still issue it to them within 14 calendar days. The implication of this provision is, although you account for VAT on the date of supply, which we have discussed before, but you can still issue a tax invoice 14 days down the line. Let's take it with a practical example. For example, you received an advance payment from the customer on 30th of September, and your period ending date for your quarterly return is 30th September as well, and you have to file the return by 28th of October. So you have not issued a tax invoice to the customer for this advance payment. You still can issue the tax invoice to the customer by 14th of October. However, the advance you have received on 30th September, you will be required to account for VAT on that advance in your VAT return for the period ending 30th September itself. And you cannot shift your liability to the month of October just by the virtue of you having issued a tax invoice to the customer on 14th of October. So this is a very important concept to understand, and this is one area where a lot of SMEs go wrong. They just account for VAT only on the date when they actually issue a tax invoice. They do not understand this concept properly, and I would request all the SME clients who are present over here to ensure that throughout the period from 1st January 2018 onwards, if they have been applying the provisions incorrectly, please get a VAT transaction audit or health check done from a consulting firm who is practicing in VAT like us or anyone you prefer of your choice, and get this each and every transaction reviewed to ensure that you have accounted for VAT in the right period. And in case the accounting has not been done in the right period, there are potential options in which certain rectifications and amendments can be made or adjustments can be made to avoid you from heavy penalties, which may result if FTA does a tax audit on your books of accounts and they find these kind of issues. Now, moving down to the supplies involving periodic payment of invoicing. Now, we're talking about a contract where, especially in supply of services, where, and it can be applying to supply of goods, where you are not doing, it's not a single contract for one-time supply of goods or service. It's a continuous supply of goods or services which you are making, in which you have to make periodic payments or you have to raise consecutive invoices effectively to the customer as per the provisions of your terms which you have agreed with your customer. So in such cases, there's a slight variation effectively as far as the date of VAT liability becoming due. And if we look at the three conditions on this slide right now, you can see the first condition is the date of issuance of any tax invoice. The second is the date of payment, which is shown as a due date of payment on the tax invoice. And the third date is the date of receipt of payment. So the important difference in case of continuous supply contracts rather than a standalone supply contracts, which we covered in our previous slides, is that here, since you cannot actually determine or define a certain point of time when the goods are supplied or services are completed or the milestones of services are completed, so you actually look at the provisions of the contract and look at these three conditions from the contract and then accrue the VAT liability based on that. So the actual supply of goods or services, when it cannot be determined in case of continuous supply contracts, that condition is relieved or relaxed by FTA, since it's not practically possible to identify for you an exact time of supply of goods or service, and accordingly they have modified in such cases the condition to earliest of these three events which are shown on this slide. So just to ensure that none of you goes asleep while we are going through very important topic, we have tried to capture a few practical examples, and while I speak and give you an answer for each of these situations, I would also like you to think and look at your business transactions which you have done since 1st January 2018, and just think in your mind whether you have applied or accounted for the VAT on the correct date. So this is kind of, we try to cover different situations for you, and each of you in your respective businesses can look at what you have done in your business, and in case you have applied the VAT liability on the correct date or not. And in case not, there's nothing to worry. There is still, possibilities of rectifying those situations. So we can always help you on a case-to-case basis in case you have not been applying historically a correct treatment. But important is at least you understand the concept correctly, and going forward you apply it correctly. What has happened in past, we can always help you in finding a solution on how to correct that out. Now coming down to the first situation, which is, let's assume an example where you have raised a tax invoice on a customer on 1st of January 2018. The due date of payment, or the payment date which is made by the customer, actually is 1st of February 2018. But you supply the goods or to them on 1st of March 2018. Now, as we discussed, it's quite a clear case. The first event in this chain of events is issuance of a tax invoice. So the time of supply in this case will be 1st of January 2018, and you're required to account for VAT on this on 1st of January 2018. Coming down to the second case, the date of invoice is 1st of February 2018. The actual payment date by the customer is on 31st of January 2018, and the delivery date is the same as before, which is 1st of March 2018. Now in this case, you have received a payment one day before you raise a tax invoice, which is quite normal in the business. So in this case, your date for accounting for VAT arises on 31st of January 2018. Why this one day could make a huge difference is, for example, you are under a monthly VAT return filing, which a lot of businesses in UAE are subject to monthly return filing rather than quarterly return filing. And your first month is ending on 31st of January. And in the second example, although you raise a tax invoice on 1st of February, but your liability to report for VAT still arises in the month of January return itself, and you cannot transfer or shift that liability to the month of February. And this is one common area where we see a lot of mistakes happening from SMEs, where they, in such cases, they have not reported the VAT liability on advance payment in the month of January, but rather have reported that in the month of February, which is not correct and needs to be rectified immediately. Coming down to the third example, you received the payment from the customer on 31st January 2018. The actual supply, since you are a manufacturing entity in this example, you take around 6 months to manufacture your goods. You make the actual supply to them on 1st of October 2018, and you have still not raised the tax invoice because you are waiting for customer to accept the goods as per the terms of your contract, and you have still not raised the tax invoice for that reason. Now, does you not having raised a tax invoice makes you save your VAT liability? The answer is no, because if that loophole was there, then people would have kept on delaying the raising of tax invoice to delay the payment of VAT to FTA. And as we mentioned, whether or not you have raised the invoice, if you have received the payment from the customer, which was on 31st of January 2018, you were required to account for VAT in such case on 31st of January 2018 itself. Coming down to the fourth example, The date of invoice is 1st of January 2018. The payment was received from customer on 2nd of February 2018. Neither the goods have not been delivered by you to the customer till date. As we speak, we are on 3rd of October 2018 and you are still manufacturing those goods, for example. In this case also, although the payment was received on 2nd of February 2018, since you raise a tax invoice to the customer, and a lot of companies follow that process, in order to for the customer to initiate the payment, the customers actually ask for you to give a tax invoice in advance. And this is a case where you are given the tax invoice to customer. The moment you give a tax invoice to the customer, since that is the earliest event amongst the three events which we discussed, so your liability to account for VAT arises in this case on 1st of January 2018. The last example which we are covering is the invoice date is 1st of February 2018. The payment date is 1st of February 2018, but the delivery date was 5th of January 2018, which was a case that you had actually supplied the goods to the customer. You forgot to raise a tax invoice to the customer, and only when you had to collect the payment from them, you raise the tax invoice on 1st of February itself. In this case, since you have completed the supply of goods or services in the month of January, so your liability to account for VAT arises on 5th of January 2018, and if you were under monthly return filing, you were supposed to account for VAT on this transaction on 5th of January and could not have transferred the liability to the month of February just because you have raised an invoice in the month of February and collected the payment in the month of February. So I hope it is quite clear, and the reasons why these conditions are put is to not give you the option of delaying the tax payments just by using certain creative techniques. So that's the reason they have made it very clear on the VAT becoming applicable on the earliest of these three events. Till now, what we have covered is treatment of transactions where all three events in a transaction happen 1st January 2018 or afterwards. The process becomes even more complicated when certain part of the events amongst the three conditions which we discussed happened prior to the VAT law becoming effective in UAE, that is prior to 1st of January 2018, and certain part of the events happened 1st of January 2018. And this is the biggest area where people try to be more creative, especially the small and medium scale enterprises. Because of the wrong advices they were given, they try to be over creative. They try to do and report the certain things in the month of November or December 2018 and thought that they will be able to get away with the VAT payment in such cases. It is not that simple. The law is very strict on these conditions as well. So if there is any part of the event amongst the three conditions which we discussed, which had happened prior to 1st of January 2018, then we have to look at what the law states. Where an invoice is issued or a payment is received prior to 1st of January 2018, the value of the invoice or payment will be subject to VAT if the goods or services become available after VAT is implemented. So a lot of SMEs did go through and ask their suppliers to raise the invoice to them with the date of December and don't charge any VAT to them. And they even ended up making the full payment against those contracts to the customers in the month of December or November itself. And they thought that they will get away without paying VAT in such cases. The law does not state so. The law says even if you have raised an invoice prior to 1st of January 2018, say in the month of November 2017, December 2017, or even in the period prior to that, and even if you have received the payment in full from the customer prior to that date, but if you provide the services or you supply the goods on or after 1st of January 2018, you're still required to charge an VAT on those transactions and pay that VAT to the Federal Tax Authority. a number of transactions which we come across when we're doing a health check or a transaction audit on our clients, we see that there are a number of cases where the VAT has not been accounted for properly in these situations. Now, the typical situations where we see that this is happening is, although the invoice was raised and the payment was received prior to 1st of January 2018, but the actual transfer of goods under the supplier's supervision happens on or after 1st of January 2018, or the goods get placed in the possession of the customer or the recipient of goods on or after 1st January 2018, or if the goods required assembly and installation. The goods were supplied physically to the customer side prior to 1st of January 2018, but you completed the assembly or installation only after 1st of January 2018. And in case it's a composite contract without any bifurcation between the value of goods and value of assembly and installation services, then in such case, the whole contract value where the assembly or installation happens after 1st of January 2018 becomes subject to VAT. In case of imports, if the customs declaration statement or the bill of entry in UAE is issued on or after 1st January 2018, then you are required to account for VAT on such import transactions under the reverse charge mechanism, which, if you all are aware who have been continuously attending to my webinars, we had covered in our webinar 2 months back. The next point is, if the customer accepts the supply of goods on or after, the services are provided on or after 1st of January 2018. In these cases as well, the contract becomes subject to VAT. Coming to the second last bullet, which I just mentioned, we are talking about a case where your contract provides that the goods will be considered as delivered to the customer only once the customer accepts post their inspection or quality inspection. And in such case, even if you had supplied the goods to the customer, say in December 2017, but the customer actually accepts the goods in the month of January 2018, then those transactions could potentially be subject to VAT. But there are certain ways, if the right structuring is done, the VAT in such cases could potentially be avoided. And if you have any such cases, please, you can contact us, and our team can also help you in addressing what needs to be done and how the transaction needs to be structured in those cases. If it is a genuine case where you have an issue, we can always help you in legitimately helping and coming you into a right structure which can save the VAT liability in those cases as well. Then looking at an example which is on the bottom of the supply side, and which is again happening very commonly in UAE, especially in the automobile sector. We had a lot of rush of customers going to buy and book their cars in the month of December and making the full payment to the car dealers in the month of December because it's a capital asset which you're looking to buy, and you want to save the VAT effectively before January 2018. Now you did everything, you rushed, you booked the car, you made the full payment to the dealer, but since, as you know, in UAE, the cars get imported from the manufacturers in other countries, so there was a delay by most of the manufacturers in being able to supply the shipments in time into UAE. And your dealer only received these cars on 1st of January 2018, and he's able to deliver it to you on 2nd of January 2018. Now, irrespective of the fact that it was a delay from the dealer side of he not having been able to deliver you the car in the month of December 2017, since the actual delivery of the car as well as the registration of the car with the RTA took place on or after 1st of January 2018, the full sale value of the car will become subject to VAT. Now, in order to summarize what we just discussed, as far as the transitional rules as provided in the Article 80 are concerned, it is quite clear if you have received a payment consideration from the customer prior to the date of implementation, that is prior to 1st of January 2018, or you have issued an invoice to the customer prior to 1st of January 2018, but if any of the following activities occurs after the effective date, that is after on or after 1st of January 2018, that is transfer of goods by the supplier, provision of services by the supplier, placing of goods at the recipient's disposal, completion of assembly or installation of the goods, issuance of custom declaration in case of import of goods, or acceptance of goods by the recipient of goods in case the contract requires that the supply is considered as completed only once it is accepted by the customer after their quality inspection. In all such cases, if these events are happening after 1st of January 2018, then your whole creative strategy of you trying to have saved VAT by having raised an invoice or having received the payment prior to 1st of January 2018 does not work, because such transactions as per law become subject to VAT. Before any of your organizations get subject to tax audits or assessment of your VAT returns, in case any of you have applied these kind of creative strategies, please, we would request you to take expert advice for a tax consultant like us or anyone for that matter, who knows the subject matter well, who can help you in correcting and rectifying these issues to avoid undue penalties being levied by FTA on you at the time of your tax return assessment or at time of tax audit of your books of accounts by FTA. Continuing with the transitional rules under Article 80, on the next slide, I would like to focus on the last three bullets on the next slide. So which distinguishes between the date on which the VAT has to be accounted for on advances in case these advances are received prior to 1st of January 2018, and there are separate provisions which apply on various types of supply of goods and various types of supply of services. So as far as the supply of goods is concerned, and if you have received an advance against the supply of goods prior to 1st of January 2018, the date on which you are required to account for the VAT on those advances in your books of accounts is 1st of January 2018 itself. So on 1st of January 2018, any advance against which the supply of goods was not completed by 31st December 2017, it's your responsibility to have accounted for 5% VAT on that advance in your books of accounts, and at the most within 14 days from that date, that is latest by 14th of January 2018, you were also supposed to issue a tax invoice to the customer showing this VAT amount which you have charged on the advance. So the implication of this is, if you are in the monthly returns and your first return was in the month of January 2018, then for any such advance payment, you were required to account for and pay VAT to FTA on this advance on 1st of January 2018 itself. The date of supply of services which fall under the Article 25 of the VAT Decree Law of UAE, as you would be aware, there are two kinds of services. One are defined under Article 25 of the VAT Decree Law of UAE, and others which are defined under Article 26 of the VAT Decree Law of UAE. So if your services are provided which fall under the definition of Article 25 of the VAT Decree Law of UAE, the date of supply for such services will again be 1st of January 2018. So if you have received an advance payment, but the service gets in December 2017, but the service gets supplied only on or after 1st January 2018, maybe you were supplying the service say in March or April, but you have received the advance from customer on December 2017, and if your service is falling under Article 25 of the VAT Decree Law, it was your responsibility to account for VAT on that advance payment on 1st of January 2018. And if you were under monthly return, then you were supposed to report that in your January month return. And if you are under quarterly return, then whatsoever your first return period was, you were supposed to account for the VAT liability on this advance on in your first return. Now, coming down to the services which fall under the definition of Article 26 of the VAT Decree Law of UAE, the date of supply will not be 1st of January 2018, but the actual date of the such service. So if it is a Article 26 service which you are providing and you had collected the advance on that service in December 2017, the advance payment still will be subject to VAT, but the date on which you are required to account for the VAT will not be 1st of January 2018, but on the date on which you actually provide such service. So these are the distinctions, and I believe it's more complicated in case of services, and which is important for you to really completely understand whether your services fall under Article 25 of the VAT Decree Law or Article 26 of the VAT Decree Law, which again is a full-fledged topic on its own. And we can help you on a case-to-case basis with that. And it takes a lot of time to evaluate whether the service falls under Article 25 or 26. So we will not have enough time on this webinar to go through those cases, but we can always help you on a one-to-one basis specific to your business on which article does your service fall under and how were you required to account for VAT on advances in such cases. So it's again now a time for a wake-up call for everyone who might be feeling asleep, since it's an afternoon time and you all had heavy lunch. So time for waking up and not getting asleep. So we have some live examples of what potentially in case of transitional provisions, where we are covering the cases where a certain part of the transaction events of the transaction happened prior to 1st of January 2018 and a certain part happened post 1st of January 2018. So the first event in that case, the first example is, let's assume you had raised a tax invoice on a customer on 24th of December 2017. The customer made you a payment also on 24th of December 2017. However, the actual supply happened on 1st of January 2018. In this case, the time or the date of supply is 1st of January 2018, and you are required to account for VAT on this supply in your books of accounts on 1st of January 2018, irrespective of the fact that you had raised an invoice on 24th December and also the customer had made the payment on 24th December. Looking at the same second example, the invoice date is still 24th December 2017, also is the payment date 24th December 2017, but the delivery date becomes 1st of February 2018. In this case, as we discussed, if it is a supply of goods or a supply of service under Article 25 of the VAT Decree Law, your date of supply will be still 1st of January 2018, and you're required to account for VAT in your books of accounts on 1st of January 2018 and not on 1st of February 2018. Coming down to the third example, the invoice date was 24th of December 2017. The actual payment date by the customer was 1st of January 2018. Whereas the delivery date from your side was 2nd of January 2018. In this case, the invoice date, since it happened in the previous period, is ignored. The earliest event post-implementation of VAT which happens is the payment date. So the effective date of supply on which you are accounting for VAT will become 1st of January 2018. The fourth example, we continue. 24th December 2017 is the invoice date. Payment date by the customer is 2nd of January 2018, but the actual supply of goods was made by you on 31st December 2017. Now, this becomes interesting. You had raised the invoice as well as you had completed the supply prior to the VAT law becoming effective. Only thing which happened after the VAT law became effective is the customer made the payment, which is quite normal. You will have a receivable standing in your books as on 31st December 2017. And you can be collecting that over the course of next 1 month, 2 months, 3 months, whatsoever is your credit terms agreed with the customer. Here, there was no supply which happened post the VAT becoming effective. and hence there is no VAT applicable on such transaction just by the virtue of the fact that the payment was received from the customer on 2nd of January 2018. Similarly, in the second last example we have, the invoice date is 3rd of January 2018. The payment date is also 3rd of January 2018, but the actual supply of goods or services was made on 31st of December 2017. In this case, although the invoice is raised in 2018 and the payment is also made in 2018, but if you have got all supporting evidences to prove that the actual supply of goods or services did take place by 31st December 2017, then also there is no VAT applicable on it. So in a nutshell, what you need to understand, the VAT liability during the transitional phase arises on whether or not the supply of goods or services has taken place prior to 1st of January 2018 and is not dependent on the date you raise the tax invoice or the date you receive the payment from the customer. The last example on our slide is the invoice date is 3rd of January 2018. The payment date by the customer is 31st December 2017, as well as the delivery date is 31st December 2017. Again, just by the virtue of you having raised the invoice on 3rd of January 2018, it does not make the transaction automatically subject to VAT. There is no VAT to be paid on such transaction. You will have a lot of your suppliers in your businesses who would have charged you VAT in such cases. And if you have such cases, I would strongly encourage that you go back to your suppliers and ask them to reverse the VAT they have charged to you, because unfortunately, if they have charged the VAT wrongly to you when it was not chargeable, you may not be able to claim the input tax credit of that VAT. And if you have claimed a input tax credit in such cases, it means you have claimed it wrongly and you will be disallowed that input tax credit, and also could be subject to potential fines and penalties once your VAT returns are assessed by FTA and the tax audit starts. The reason why a lot of people are not aware of this situation is because the return assessment and tax audits have not started by FTA. But what we understand is it is going to start very shortly. We could see tax audits and tax return assessments starting as soon as in the month of November and December. Just before you get into that phase when FTA starts knocking your doors, please make sure if you have done any of these errors, take advice from proper tax experts and correct those errors. Now, having gone through the provisions of the VAT decree law of UAE and the transitional provisions which are applicable if you have certain events happening prior to 1st of January 2018 and certain events in the transaction which are happening after 1st of January 2018, I believe you all now understand fully what the VAT decree law and executive regulations governing it say. Now we come down to the actual accounting entries for advance payments received. So that becomes even more complicated, because having understood the law, if you don't know how to apply it correctly in your books of accounts, the problem is half solved, and we are here to solve the full problem for you. So we are going now to focus on accounting entries for advance payments received, and we have covered 2 different case studies through which we are going to explain to you how you are required to account for VAT in your books of accounts, keeping in mind what the accounting standards provide for and keeping in mind what the VAT law provides for. That is the reason we always say the VAT law does not have to be looked on a standalone basis. It has to be looked alongside a combination of factors. And when we advise our clients on applying the VAT in their businesses, we take into consideration all those factors, and accounting standards are one very important factor. So in case you have any issues which are relating to how do you account for certain entries in your books of accounts because of the change in the system resulting from VAT, you can always ask for our help and we are there to help you out. Let's take the first case study. And in the first case study, We are assuming that you were supposed to receive an advance payment of AED 100 from a customer on 4th of October 2018, which is tomorrow. And the total contract value for the supply of goods or services which you had entered into with this customer is worth 300 dirhams. Now, in such a case, when you receive this advance on 4th of October 2018, what you are required to do is to issue a tax invoice to the customer with AED 100 mentioned as advance payment, and you also have to charge 5% VAT, which is AED 5 in your tax invoice which you're issuing on 4th of October 2018, and you will be required to collect the total of AED 105 from the customer. When you do this, the accounting entries that you will need to pass in your books of accounts for receipt of this advance payment are: for the advance you receive, the entry will be bank account debit to customer account. You have a general ledger account you have created for that customer. You have received 105 payment into your bank accounts, or if you receive it in cash, the bank account will be replaced with cash account. So the entry will be debit side 105 on your bank account to customer account. It stands as a credit balance towards the customer for 105. Then for the tax invoice which you have issued, you will be putting the accounting entry as customer account debit 105 to output VAT account credit 5 and to sales advance account, which is going to go into your balance sheet, which is 100. If you note the entries carefully, we are not recording a revenue or a sale at the point of receiving the advance, because the revenue will be recorded only when you do the actual supply of goods or services. This is what the accounting standards provide for. But since we are issuing a tax invoice, we still have to account for. So this advance which we've collected, that goes as a balance sheet entry as a sales advance. Just by the virtue of you having raised a tax invoice, it does not automatically translates into revenue into your books of account. And this is 90% of the businesses or SMEs which we have come across have done this mistake, that when they record the tax invoice, they straight away record the revenue at the same point of time. But that is not correct. That is not the case you have to do. So again, if you have been, all your accountants have been doing this, please get a VAT health check or a VAT transaction audit done by a tax consultant. And we have done a number of these for our clients, and we have found this mistake happening quite often. So the right entry, as we have mentioned, is customer account debit to output VAT account to sales advance account, which is goes into the balance sheet. Now, coming down to the accounting entries in the same case study, what happens when you actually supply the goods or services to the customer? Now, let's assume on 4th of November 2018, you make the actual supply of goods or services to the customer. Then at that point of time, you will need to pass the following accounting entries in your books of accounts. The customer account will be debited for 210 because 100 you have already debited to the customer before. Now the new debit, which is the payment which the customer is required to pay you, is on the 200 dirham outstanding liability plus the 5% VAT on that 200 dirham, which is 10. So the customer owes you 210. So you'll be debiting the customer for 210. Your sales advance, which was standing in your balance sheet, which we recorded on 4th of October, so that now will be reversed. So we are going to, it's standing as a credit balance in your balance sheet. So now to reverse it, we are going to do the entry of sales advance from the balance sheet. We are going to debit it for 100. The output VAT, which is due now on the new tax invoice which you are issuing for the balance payment, which is for 200 dirhams, that is only 10. And the sales, which is now going to go into your profit and loss account, and you're going to now record the revenue, is going to be reported for 300, which is the full contract value which you have agreed. So it's a very simple, basic alignment of aligning your accounting standards requirements to the provisions of VAT law. And this is not just one area. We have this conflict happening in a number of cases where people are not able to align the provisions required by the accounting standards to the provisions required by the VAT law. And that is where you require the help of proper accounting and tax experts to help you out if your accountants are not able to sort these conflicts between VAT law and accounting standards while recording the entries in their books of accounts. There's always a right way of doing it, and I believe with this example on advances, it becomes quite clear on how you're going to report your accounting entries on advances. Now, as far as the customer who is receiving these tax invoices from you are concerned, they will be able to claim the input tax credit of AD5 against the tax invoice which you have issued for advance payment on 4th of October 2018. And in the month of the October 2018 itself, if their tax return period, for example, is ending on 31st October 2018, they will be able to take the input tax credit of that advance payment and the VAT basically charged on that advance payment in that VAT return itself. Now, when they receive the second tax invoice from you, which is for the balance 200 payment and the AD10 is charged as a VAT on that, they will be able to receive the input tax credit of that AD10 in the month of November, and they will be able to record that input tax credit in their books on 4th of November 2018. That is the time when you are issuing them the second tax invoice. So as far as the customer is concerned, it is their eligibility to claim input tax credit becomes only and only when they receive a tax invoice. If they do not receive a tax invoice, even if they have made the payment of VAT and made the payment of advance, they cannot claim input tax credit forfeit. So it is important that the customer receives the tax invoice from you for them to be able to claim the input tax credit of whatsoever VAT amount has been charged by the supplier. Now, taking the case study 2, where we have just made slight modifications and again to make you understand what could potentially happen in a practical business environment. Now, in a similar example to case study 1, there could be a situation when the customer has to pay you AD 100 advance as per your agreed contract terms, and you ask him to pay additional 5 dirhams of VAT on top of it. He may refuse to pay you the additional 5 dirhams. In that case, when the customer is paying you AD 100 advance, it will be considered that 100 which you are receiving is inclusive of the VAT amount. So you have to segregate that 100 into the VAT and the actual advance payment. And if you work backwards, the actual amount comes to 95.24. That is what you will be reporting as an advance payment. And the 5% VAT on the 95.24 becomes 4.76, with the total payment being received from the customer being 100. And you will see this quite often in the practical business environment where the customer says, I was supposed to pay you 100 now, I will pay you only 100, I cannot pay you 105. So in this cases, what you need to do as a supplier who's receiving an advance from the customer, you need to bifurcate that 100 into 2 portions while raising your tax invoice and show the advance payment of 95.24 and the VAT of 4.76 and give that tax invoice to the customer. So when you do that, for the advance received, again, you will pass an accounting entry now of bank account debit 100 to customer account 100, because you have only received 100 dirhams in this case and not 105 dirhams as was happening in the previous case study we covered. Now for the tax invoice which you have issued, you will be debiting the customer account by 100. Basically, by debiting the customer account in this entry and by crediting them in the previous entry, you are offsetting the customer account effectively, and the net effect of the entry remains as bank account debit 100 to output VAT account, which is 4.76, to sales advance account, which is the balance sheet entry, which is 95.24. That is the net effect, but you still need to pass these 2 entries in order to ensure that your general ledger account with the customer is tallied properly. So don't take the shortcut, although the net effect is what I've told you, but just follow these 2 entries which are shown on your slides. So now coming down to the time of actual supply of goods or services in this example, we are assuming the same date, which is 4th of November 2018, when you actually supply the goods or services to the customer. In this case, you will be issuing them the tax invoice for the balance amount which is due from them. Now, the total liability which the customer was supposed to pay on a total contract value of 300 is quite clear that on 300 dirham contract value, there's a 15 dirham VAT at rate of 5%, which becomes applicable. Now, the customer has already paid 4.76 dirham of VAT at the time of making the advance payment. So now the remaining liability which the customer is required to pay as far as the output VAT is concerned is going to be 10.24. And out of 315, he has already made you a payment of 100. So remaining outstanding amount is 215. So the customer account will be debited for the remaining outstanding amount from him, including the VAT amount, that is 215. The sales advance, which we had booked in our previous entry, which is 95.24, which will now be reversed. And we have sales advance debited 95.24. The output VAT is credited, which is the liability which we are paying now to FTA by the virtue of we having raised the tax invoice for the balance amount, that is 10.24. And the sales and the revenue which we'll be reporting is 300. So it's as simple as that. There's no real complication. The only difference which we have taken in this case is that the advance payment which the customer made was inclusive of VAT, and accordingly all the entries will undergo a change in terms of numbers. And now these are very subtle differences which happen on a day-to-day basis in different transactions. And due to the workload of the accountant, they're not really able to focus properly on, or not able to think clearly what they need to apply as an accounting entry, due to which a lot of mistakes have happened. And the problem with the mistakes is if the same accountant looks at it even 5 times again, he will not be able to notice his own mistake. And given that we are seeing 90% of cases when we do a VAT transaction audit or VAT health check on our clients, we are seeing these issues quite often. We advise each of the organizations who have similar kind of issues, please get a kind of a VAT health check or a VAT transaction audit done from a tax expert, so that when an independent set of eyes look through it, if there are such errors, they can be corrected before your organization is subject to a tax audit or your VAT returns are assessed. Please don't live in a fool's paradise that FTA is never going to assess your VAT return or FTA is never going to do a tax audit on you, and whatsoever you have done, you will get away with it. Because in this country, in UAE, once you are subject to fines and penalties, they are going to be quite severe. And it's better to correct if anything has gone wrong rather than them or FTA finding it out at the time they do the assessment of your VAT return. Because even when they do the assessment, they're going to ask you for all the backup data and documents, including your books of accounts. So at that point also, they will come to know if you have not applied something correctly. Hence, we strongly recommend please have an internal look at your systems, and in case you're not able to find or able to observe some errors internally, please take the help of an external tax consultant, because these are very, very common areas where most of the small and medium scale enterprises are committing mistakes. And that is the reason of me emphasizing it again and again, since from practical experiences, we are seeing these kind of mistakes happening day in, day out from SMEs. So hence, we are requesting all the SME businesses in particular to please look at these aspects very carefully. And if these things are not happening properly, of course, going forward, you are going to, change this. But at least if it has happened not correctly in historical past, there's always a way to correct it out and report the correct numbers to the Federal Tax Authority. Now, as far as the customer is concerned, whatsoever amount of VAT you have charged on advance payment, which is AED 4.76 in this case, they will be able to claim input tax credit of that in the month of October itself. And for the remaining amount of 10.24 of VAT, they will be able to claim the input tax credit of that in the month of November 2018. Now, coming down to the last topic of a presentation on advances, it's more pertinent to businesses which are actually into retail sector or into retail businesses. What happens in case of retail businesses? It's quite a normal marketing technique that they issue vouchers to the customer which can be redeemed against the supply of goods at a future date. Now, what is the treatment of vouchers? Are the vouchers considered as an advance payment because you're supplying vouchers to customer and customer may be paying you for it? There are two kinds of vouchers. One, which are you sell those vouchers, customer it's a gift voucher of 500 dirhams and customer pays you 500 dirhams, for example. And there could be others which are given as a gift voucher free of cost by you to the customer. Now, whether these vouchers are considered as advance payments or what is the exact treatment which applies in case of vouchers, a lot of retail businesses are not able to understand and apply that correctly. And hence, we have covered the provisions of the law and then we cover it with examples subsequently. As per the Article 7 of the VAT Decree Law of UAE, which covers supply in special cases, the sale or issuance of any voucher is not considered as a supply unless and until the consideration received for this voucher exceeds its advertised monetary value or the voucher is issued as a gift. It's quite a heavy wording for most of you to understand. So that's the reason we will cover that with examples which are shown below. Now, in the first case, you have an example where the voucher is issued at a premium. That is, the face value of the voucher is AED 1000. However, you are issuing it at a 10% premium and you're selling that voucher which is worth AED 1000 at 1100 and you're collecting 1100 from the customer. In such cases, the 100 extra which you have collected from the customer over and above the face value voucher, that is kind of supply of service which you have provided for selling that voucher, and that 100 extra payment which you have received from the customer will be subject to VAT at the point of the sale of voucher itself. As and when the customer redeems this voucher worth 1000 dirhams against supply of goods, he will be charged the VAT at the point of sale when he actually redeems the voucher. So there is no advance on 1000 on which VAT needs to be accounted for on the date of sale of voucher. On the 1000 dirhams, the date of accruing the VAT liability arises only on the date of actual redemption of the voucher against which you supply goods or services. And the similar is the case 2. In the case 2, the voucher is issued at par. So there's no premium you're charging. It's a 1000 dirham voucher. You're selling it for 1000 dirhams. So there is no service fee on which VAT becomes applicable at the date of sale of voucher. Only when you redeem the voucher on the date of actual supply of goods or services, that is when on the 1000 dirhams the VAT becomes applicable. So it is not, in a nutshell, a sale of voucher is not considered as, and you're receiving the payment although, but it's not considered as an advance payment because the sale of voucher is covered by explicitly separate provisions provided under the VAT decree law and the executive regulations. Coming down to the third case, you could be selling a voucher as a part of promotion scheme at a discount. So the face value of the voucher is 1000 dirhams, but you sell it at a discount for 800 dirhams. In this case, when you redeem the goods, the value of the voucher is 1000, which means you are selling goods worth 1000 to the customer, and you will have to issue a tax invoice at time of redemption of those vouchers and again supply of actual goods for 1000 dirhams and not, effectively, but the 200 dirham at which you have basically sold the voucher at discount will be shown as the discount in your tax invoice. So your net value of the tax invoice will be 1000, which is the value of your goods minus 200 as a discount. So net taxable value on which the VAT is charged in this case will be 800 dirhams and not 1000 dirhams, because as we know that the VAT is applicable on the net consideration and not on the gross consideration. Coming to the last example, and after which we will open the floor for the questions and answers, is if the voucher is purely given as a gift. You have given the voucher free of cost without any consideration at all. In such cases, the law says that it is a deemed supply. So you have made a deemed supply of that. But the deemed supply does not happen on the date of supply of vouchers. It happens when the customer goes and redeems these vouchers and takes supply of goods against that. So basically, in case of deemed supply, whatsoever is the cost of those goods, you basically have to account for output VAT on the cost of those goods, or alternatively, whatsoever is the input credit you had claimed on the cost of those goods needs to be reversed. That is the provision of deemed supply, which you have to apply in case the customer redeems the voucher which has been supplied by you free of cost. In the case the customer never comes to redeem the voucher at all, then it never becomes supply. So these are the provisions which I believe we are quite clear to you, and we really wish each one of you that you should be able to apply this complicated set of things in your accounting books as well in your businesses after this webinar in a correct manner. And in case you need any further help on a case-to-case basis, you can always contact us. Contact details are available on the last slides of this webinar, which you should be able to see on your screens, or you can contact Zoho team and we can connect and coordinate from there on. Thank you so much.